My name is Brian Mashian, and it's my pleasure to welcome you to today's conference. And I'd like to introduce our sponsor of today's event, Kareem Jowdy. Kareem Jowdy, he's your partner in real estate, and he's founded and opened 19 successful companies in 8 countries. He made his first million by the time he was 26 years old, buying and fixing up distressed properties and businesses. I've known Kareem for many years, and I have to tell you, on a personal level, Kareem has been very professional and very kind, and he does a lot of philanthropic activities besides his business activities here. He genuinely adds value to the deals that he brings people to. He raises money for lots of different products. He's done everything from single family to condo projects, apartment buildings all over the country in different states. And I look around the room and I see so many different people from so many disciplines, which is actually representative of how Kareem's connections with different people. And he has a lot of experience building from scratch, remodeling, fixing up all different product types. And hopefully you'll enjoy today's conference. And I'd like to invite Kareem Jowdy to join us on the stage.
On a cold, rainy February evening, I landed at Los Angeles Airport with no money, no friends, and no command of the English language. 36 years later, I have made wonderful friends. I have made some money, but I'm still struggling with the English language. All I had was $17 and my American Express card. Don't leave home without it. Obviously, many of you are not old enough to remember that. You may say, wait a minute. In Los Angeles, $17 is barely enough to buy a map of the star homes. How did I make it? I'll tell you how. I chose a low to middle income area close where I want to live. Mar Vista, Westchester, Culver City, and Venice. I talked to everybody I met about what I was planning to do. Attorney, CPAs, banker, property manager, real estate agents, anybody who was willing to listen. In a few weeks, I made over 30 offers on every house on the market, plus half a dozen houses which were not on the market. The first 2 real estate agents I worked with thought I was not realistic and gave up too early on me. The third real estate agent was so impressed that he chose to invest his own money with me. So did my attorney and one of his friends. That was my first syndication in this country. We bought the first house in Mar Vista, fixed it up, and sold it. With the profit, we bought 3 houses. The rest is history. Of course, I continue to make offers. As a matter of fact, we're still making an offer every day. However, now our focus is on value-added apartment buildings. Friends, I'm not saying this to brag, but to tell you, if someone can come all the way from Lebanon with no money, no friends, and no command of the English language and succeed, each and every one of you can succeed. Because if you know what you want and have a deep desire to succeed, you will not let the few rejection discourage you. Commitment and persistence are the key to success. Good morning, I am Kareem Jowdy, your partner in real estate. I have a tendency to speak fast. If at any time you cannot understand me, please bring it to my attention. With the SEC approval of Regulation A+, in addition to Title III, 2016 will be remembered as the benchmark year from which we track the participation of retail investors along with the accredited investors. The real estate syndication industry is evolving on a daily basis and is changing much faster than any of us expected. As a matter of fact, there were more changes the last 2 years than there have been in the last 30 years. And crowdfinancing is really the new form of syndication. It's exactly syndication, but now we can do it online. It is natural for real estate industry. It expands the pool of investors from whom funds can be raised beyond the traditional circles of owner relatives, friends, and venture capitalists. It is now easier and more popular than ever to get into prime commercial real estate. Crowdfinancing has made it possible for the individual investors to get access to institutional quality deals along with full transparency. This has never been possible before for real estate. It also greatly reduces the time and capital requirement needed to invest. With all the information and choices available at their fingertips, investors are able to make their own choices. We are seeing some very big and well-known finance and real estate company jumping into the crowdfinancing arena. So not only will there be more volume across the board, but at the upper end of the marketplace, we will see some of the leading firms in the country announce that they have a new crowdfinancing offering. Moreover, crowdfinancing has been gaining traction, and it's clear the result will be far-reaching. Each day, more and more real estate investors are turning toward crowdfinancing for their investment and financial needs. Definitely, crowdfinancing will affect the future of real estate investment and finances. So to survive and thrive, we need to not only adapt to the future, but also create the future. Ladies and gentlemen, that's why we are holding this conference today, to help you join the revolution and create the future. Some housekeeping. Please silence your cell phones and the person sitting next to you. Lunch will be served in the terrace outside here, and network with the speaker and each other will be also outside here at the end of the conference. With that, I will introduce you to our first keynote speaker, Steve. Are you available? Steve, are you ready? Okay. Audio.
Thank you, Kareem. Well, good morning. My name is Steve Sadler. I am the CEO of Allegiancy. We're a commercial real estate asset management firm that is engaged in the Regulation A+ process right now as we speak. You'll see us pop up in the presentation here in a minute. And what I want to start with is just a conversation about the landscape in commercial real estate and crowdfunding, Regulation A, et cetera. So the remote control somehow got lost in transition. So I've got my friend Howard is going to push the button for me. Take it away, Howard. So the Jobs Act passed in 2012 is clearly a catalyst for some major changes. It took a while for the rules to come out, but for the first time in living memory, investors are able to get closer to opportunities rather than farther away. It's been a very long time since there was securities reform, and we think this is a very big deal. It's really rocket fuel for the entrepreneurial class. It's rocket fuel for the American economy. And just like a Saturn rocket, you've got 3 stages. First is 506C, which is called, what is that in Reg A language? I think it's Title II. This 506C allows you to solicit public solicitation of accredited investors on private placements. Brand new idea, had never been done before. Everyone thought it was going to be calamitous. But it really hasn't been. But for a sponsor, this is the first time you've had the opportunity to create a brand for yourself that the public can see and hopefully would be recognizable and ultimately have value for you in the long term. So 506C was the first important part. That really is the exemption, the securities exemption that a lot of your larger platforms, Realty Shares, Early Shares, et cetera, that's what they're relying on is the 506C exemption. The next big piece was Reg A+, and those rules became effective something like August of 2015. And then Title III is happening now. Title III is what I call the real crowdfunding, which allows anybody to essentially raise money from anybody. And the rocket's taking off, it's building up momentum, and good things are happening. We're seeing a lot of activity in the marketplace and a lot of change. And in our view, what you're about to see happen to Wall Street, to the investment banking and private equity markets is a lot like what has happened to the taxi business. Uber came along, nobody was paying attention. All of a sudden, it's better, it's easier. The economics of the Uber system are far superior to a traditional taxi company, and Uber has taken off. You can see ridership skyrocketing. You have a little bit of latency in the early months, and then all of a sudden, in all of these cities, Uber is everywhere. You see the same thing with Airbnb. Again, you have a company that's leveraging technology to take over, essentially, a very large, very established industry. Airbnb is the third largest hotel company in the world now, with more room nights than almost everybody else. And you can see that power curve of growth. We think you're going to see the same thing in the securities world under the Jobs Act. You're going to see some amazing changes. 506C is a big part of that. The private placement marketplace for Reg D private placements is more than 100 times the size of what Regulation A offerings have been in the past. So that is the sort of the belly of the beast in terms of actual securities offering. And for an investor to have the opportunity to be exposed to offerings via the internet, on a platform, direct communication with the sponsor, is a new and powerful thing. And we're talking about disintermediation. The brokers and the registered reps are no longer required, and you think if you're one of those people, you need to be careful because you cannot rely on filtering information for your livelihood anymore. Your clients will have access to direct investment opportunities, and so if you're not in the game is going to roll right over you. This is a great example. It happens to be an affiliate of ours, Real Estate Value Advisors, did a commercial real estate investment syndication using the 506C exemption. This offering was placed on Early Shares platform, was available to the public. Obviously, there's a process of validating that you're an accredited investor before you can see all of the offering documents, et cetera. But we did this offering on a Class A office building based in Raleigh, North Carolina, that's paying about a 7.25% cash flow for institutional quality stuff. Prior to that time, very unusual for an individual investor to have access to an asset like this. And we had some success on Early Shares, and that's, for us anyway, it was a test and it's an exciting opportunity. And we're doing it again. We have another office building asset based in Charleston, South Carolina, also paying out about a 7.25% coupon that is going to go up on Early Shares here shortly. So again, what you're seeing is a lot of, if you go to these various things, Realty Mogul, Realty Shares, Early Shares, what you're seeing is a lot of small transactions, but more and more institutional quality, seasoned professional sponsors are showing up. And I think that transition is going to accelerate. And so the second piece is the new Reg A, or A+. Here we see this as a major innovation. But the thing that's interesting is the 506C is really where all the real estate activity has been. To my knowledge, to date, there has not been a direct real estate offering under Regulation A+. And there's some reasons for that. There are reasons that you haven't seen those yet. One of the reasons is that the timing of getting things approved through the SEC is particularly painful for a real estate deal. And so what you see under Reg A right now are mostly operating companies. You're seeing growth companies going out to raise capital rather than doing a venture round, or going out to raise capital rather than taking private equity money. They're raising it directly from an interested public and reaching those investors without the limitations of an accredited standard being required. And so a company has an improved ability to source capital, to reach out to interested parties, build an audience, and raise that capital, in theory, more cost effectively than you can through a traditional private equity or a joint, or I'm sorry, an angel or venture capital group. And you have, at least in theory, the ability to maintain more control of your company, not ceding control of the board, et cetera, to a third-party outside investor. And I think one of the things that we have to think about is the size of this opportunity. Not every company is going to be a Google, but if you look at the public equity markets in the blue dot, that's how big that market is in dollar terms as compared to private companies. And so for private companies to be able to raise capital more efficiently using Regulation A+ is a very big deal. And it should be something that can dramatically improve our economic performance, dramatically impact job creation, innovation, technologies acceleration, and as Kareem was saying, defining and building that future. So we think this is a big deal. And Allegiancy is taking advantage of that opportunity. We are a commercial real estate asset manager. We don't own the properties, we make the properties perform. And Allegiancy is a fee-based, pure play, and we're in the market today raising $30 million under a Reg A+ offering. And that's something that, actually we're not in the market today, we'll be in the market on Monday. The SEC has just come back with sort of, all clear signals for us. And so our offering is the kind of thing I think you're going to see more and more of. It's a young company that's profitable today. We're offering $30 million in common shares. We expect within 12 months to declare a 4 to 6% dividend on those common shares. The shares will be liquid and tradable on the over-the-counter, the OTCQX exchange, where names like Heineken and Roche and Bombardier trade today. Our operations are profitable. We're fee-based and counter-cyclical, which is to say that in the downturn, our asset management operation was more profitable and had growing revenues, where a traditional sort of real estate ownership model in the downturn was suffering. So you have an opportunity as an investor to gain exposure to a real estate asset class without all of the volatility of direct equity ownership. And so we like to say that Allegiancy is an offering where you get more alpha with less beta, and that's a good thing for portfolio diversification. And the company is growing very fast. In the last 24 months, we've grown at a 400% clip. And from our perspective as an investment, this is kind of a boring company. It's not sexy. We're not making cute little gadgets and I don't know, fancy watches or something. But what we do is manage a piece of a very large business. Commercial real estate is more than a $15 trillion asset class in the United States, roughly equivalent to the total equity markets and publicly traded equities in the country. The industry throws off $886 billion in revenues each year. So in our case, Allegiancy is implementing technology to make those operations more efficient. And if you can move the needle just a little bit on an $886 billion revenue industry, you can have an awfully big impact. And we are a market-leading pure play. We're the only guys out there that are a public or are headed to be a tradable liquid security that does manage real estate on a fee-for-service basis and doesn't get bogged down in all of the other things. So real estate is a unique industry in that you have the 1950s vertical integration sort of mindset where everybody tries to do everything for everybody. And you'll have a large name like CBRE, and they're doing leasing and property management, investment sales, they're doing financing and capital markets, they're doing everything from soup to nuts. And it's hard to imagine that anybody really believes that's the most efficient, that they can actually be the best at everything. And so at Allegiancy, we've chosen to specialize, focus a lot of our energy on building a technology platform that allows us to compete and to excel. And that has delivered 250 basis points of improved return on equity for our property owners, which is a big deal, again, in a $15 trillion market. And we are currently all across the country in 24 different cities, 11 states, with about $1 billion of assets under management. And so there's the little picture. And so part of what I'm trying to communicate here is that not only is Allegiancy, in our view, a great example of what's coming in Regulation A+, it's a company that with additional capital will grow very rapidly. We have 25 employees now. We're expected to be about 50 employees by the end of the year. And so you see that the capital goes to work in the company. Your opportunity is to invest in these companies earlier and get a bigger piece of the growth and the gain that heretofore has been largely captured by private equity investors that most of us didn't have access to. So from Allegiancy's perspective, we bring a seasoned team, we bring serious technology and stunning growth, and we think it makes for a great investment. And starting next week, we'll be out telling that story in earnest to investors all over the country. And so back to the big picture, Title III is the third part, or the third stage of the rocket that I described earlier. Title III is true crowdfunding that would give essentially any individual the opportunity to go out and raise $1 million of capital from investors with little or no criteria attached. You don't have to be accredited, you don't have to be rich, you don't have to be smart. You're able to invest in whatever that offering is. There are some problems with the way the rules have been written in Title III, and those are being at least talked about as something that might get addressed. But I don't think you're going to see a big impact, at least for the moment, with Title III, particularly in real estate because it's a small dollar amount. I mean, $1 million of equity sounds like a lot of money until you try to actually go out and buy some buildings with it and you find that it's really not that much. So we'll see how Title III works out, but I think for most people in this audience, focusing on 506C and Regulation A+, that's where most of the action and most of the dollars are going to be going forward. And I think that's it.
Our panel will be discussing today where and how to find the best commercial real estate properties in today's market. Evaluate and analyze the investment to make sure it will give you the right return, and multiple ways sponsor can be compensated. Now, each speaker will have about 3 to 4 minutes to tell us about himself, his business, and then we'll open to questions. In Lebanese, we say, the shy sleeps hungry. Don't be shy. You are here to learn. Ask your questions because you cannot, the best way to learn by asking questions. And you have a fabulous panel here, very experienced, take advantage and ask them their questions. We start with Brian, 3 to 4 minutes.
Good morning, everybody. My name is Brian Mashian. I've been practicing commercial real estate law for 31 years, 32 years, and my focus is on representing investors, landlords, tenants, buyers, sellers. I represent people who invest in real estate from cradle to grave, from acquisition of the land to entitlement and helping construction, leasing, financing, and disposition, and then doing 1031s, keeping the money invested in real estate. I represent people in negotiating the deal, doing the documentation. I've been teaching at UCLA Extension various classes on different aspects of real estate law. Right now I'm doing a class on advanced legal aspects of real estate. And I'm also an investor myself. And that's about it. I don't think I need 4 minutes, Kareem.
Good morning. My name's Eric Garfield. I'm an MAI real estate appraiser. There's always some very intelligent person in the room who knows what MAI stands for. So why don't we get it over with? Who's the person? Nobody today. Interesting. I'm accustomed to. Pardon me? Very good. I'm used to anytime I get up and say hello, somebody always yells out, "Made as instructed." And so I'm pleased to hear that didn't happen today. I'm a partner at the firm Anderson Tax, which is what remains of Arthur Anderson, the accounting firm. And we're a worldwide tax compliance and consulting firm, and I lead the firm's real estate consulting practice, generally on a nationwide basis, working primarily with high net worth clients that have real estate assets held in trusts. They're making gifts, they're moving in and out of estates, passing on to children, dealing with death. So generally speaking, have to see almost every single commercial real estate property type, from apartments, industrial, shopping centers, office buildings, and development land, to residential properties. Thank you, Eric Garfield, Anderson Tax.
Hello, everybody. My name is Brent Sprankle. I'm a partner with a company called Berkadia. We're a national real estate brokerage and lender. I've sold about 300 apartment buildings and development sites here in Los Angeles over the last 15 years, mostly between downtown and the Valley, West Side, some in the South Bay. As mentioned, we're also a lender. We're, I think, number 1, 2, and 3 with HUD, Fannie Mae, and Freddie Mac. So we do a lot of debt, but I'm really just on the sales end. I'm kind of more of a standard apartment building broker more than anything else. I have sold Kareem buildings in the past. He's gotten some very exceptional deals from me, I must say. Done a lot of REO buildings in the recession, note sales, short sales, a lot of distressed properties. That market, unfortunately, has gone, and we're back to a very different reality now that we are typically in Los Angeles, which is very low cap rates. As far as crowdfunding goes, I wasn't sure if we'd ever see it in this market, but last year in the fourth quarter, I sold a development site on Melrose, and the buyer's broker came to me and said, we need a little bit of an extension. The buyer is crowdfunding the entire all the equity is coming from crowdfunding. I was shocked to hear that, but magically all the money showed up and we closed, and that buyer put the entire thing together and is going to build about a 40, 50 unit apartment building on Melrose just east of Western. So it does work. As far as apartment buildings go, we all know it's an expensive market right now. A lot of that's based primarily on interest rates as well as the economy and just demand to buy residential real estate. People feel apartment buildings are going to do very well in infill locations in Los Angeles. My general comment to people is there's really 3 ways to get into the apartment market. One is save up some money and go buy your own deal. A lot of competition. It's a 4 cap market, as mentioned. You're not going to get much of a yield. You got to buy something that's value added. The second is go get a bunch of partners and put a deal together. That sounds a lot easier than it is. And the last is buying with a sponsor, somebody like Kareem, who finds a deal and brings investors in, and that tends to be pretty much the easiest way to get started. We'll go on to you, Michael.
Okay. Yes, my name is Michael Deutschman, and I guess I'm the CPA of the group, at least one of them. And I'm a partner in the firm of Anton and Shine. We're a full-service CPA firm here in California. We do lots and lots of public companies. We do real estate. We have an office in Newport Beach, Westlake Village, and in Del Mar, California. And my specialty has been in real estate going back for 40 years, essentially starting in New York with what was then Pete Marwick. And I've owned it, I've syndicated it, I've developed it, and I've written books for the American Institute on how to prepare the financial statements for real estate companies that are in accordance with GAAP. I've worked in the United States Securities and Exchange Commission in the real estate section where the largest REITs are formed. I've taught real estate taxation to CPA firms and to CPAs. And I've done lots and lots of work with lots and lots of properties. And I guess my expertise today is on how to analyze a real estate investment. So I'd be happy to answer any questions that anybody might have on that.
Thank you. And I am Kareem Jowdy, your partner in real estate. We specialize in value-added, especially apartment building from Texas West. And we talk about value-added. Brent mentioned earlier that the competition is fierce, not only tough, it's really fierce, because we have a huge amount of capital, not only locally, but from overseas, chasing fewer deals and fewer deals. So the cap rate is really getting lower and lower, and the return is sometimes obsolete. I haven't bought any building in Los Angeles area for about 2 years now. A few years ago, I didn't buy any building in California for 7 years. However, I am buying in Phoenix and Las Vegas and some part of Southern California, but not here. The reason why I'm buying those areas because that's where the value added we can do. When you do value added, if you buy a building in West Los Angeles, and I tried to find one of the speakers here actually, he asked me to find a building in the west side. I couldn't find anything. Even for 3 caps, 2 caps, couldn't find a good deal. So the market is tough, but there's still opportunity. You have to find where are the opportunity. We have to work now for about, at least I look at 200, 250 setup from brokers, from other way, and I have a list. Anybody interested in how we find the properties, I can email it to you. So 250 deals to make maybe 30 or 40 offers to buy one deal. But there are good deals. It's harder to find. So we'll be talking more about this in detail. But first, I'd like to open it to questions. Anybody has a question? Again, remember, in Lebanese we say, the shy sleeps hungry. Don't be shy, you don't want to sleep hungry. Who has a question for any of us in the audience? Wow.
A lot of hungry people in here.
Wow.
Not enough coffee yet, I don't think.
Zara, tell them to get us some more coffee because some people have to wake up. Sure.
Suppose a beginning person in real estate has no money and would like to figure out a way to get into investing in real estate. Would you like to discuss that?
Of course. Anybody would like to do it or sell it?
I think if you have an interest in real estate and you want to own it and you want to start getting involved in it, what I've seen people do is whatever your expertise happens to be, you can barter that for an interest in a property, perhaps. So in it, what people do if they're carpenters or they're construction people, lots of times instead of getting paid a fee for doing their work, they'll roll that back into a deal because they believe in it. You know, lawyers do that sometimes. In certain situations, accountants can do that sometimes. So, you know, whatever it is that you do for a living, you could get started by, instead of taking, maybe you take part of a fee for what you do, and the rest of it you put it into a deal. Or what you could do is you could get together with a group of people. Historically, what people do is they form friends and family kind of things, like almost like investment groups. You can form 4 or 5 different people, and you can go ahead and form a partnership and buy a property. Your role conceivably could be, if you're not providing the capital, is you could go and locate the property. You could basically bring leasing to the property. I've seen deals get put together like that. So you can form a group where you can take whatever value you have and bring that to bear on a piece of property. And that's the way a lot of people get started.
Gene, for everybody here, have you heard of a word called OPM? Other people money, or actually this syndication, it's crowdfunding. It's the same thing. What is crowdfunding? Crowdfunding is a new form of syndication. It's online. Crowdfunding has been, syndication has been around for 500 years. This afternoon we have planned especially about raising the capital, but the best way to do is use other people money. By using other people money, like I did myself, I had $17. How you do it? Talk to people and don't be afraid. Ask, because if you don't ask, you never get. But you have to learn what you are doing first. I made 30 offers, actually 36 offers to buy one house. That was in 1979. There are many ways you can associate yourself with one of us who has been doing this for years. We have several people in the room here who can help, including me. So there are many ways and many other questions here. Eric.
Yeah, just a point of reference too, not to advertise Kareem's book, but I've read Kareem's book. Has anybody else read Kareem's book? Kareem's book actually answers that question precisely, and the stories that we've heard from Kareem today, I think, are indicative of that. And to tailspin on what Gene had to say. Find a property. You find yourself the property. Do all the diligence. And once you have that, then find a partner like a Kareem Jowd, which is essentially what he says in his book that he did, coming here with with no money and an Amex card. Basically, finding the parties that have the means of financing a transaction like this, once you've done all the diligence and legwork and can establish and prove to somebody that, hey, you know what, this is a bona fide good deal. In addition to seeking out a partner like Kareem, and I know from just attending Kareem's other groups too, if you find him one of these particular deals and you don't have the money to actually do it, I think he'll either buy it or give you a referral fee for identifying it. So they're, clearly find a partner in real estate like a Kareem. But certainly there's tremendously advantageous financing out there now too. And so to the extent that you speak with financing folks, mortgage brokers, mortgage bankers, and bankers, clearly there's a way to have very high leverage and find these properties once you've done the diligence. You're probably going to need a couple of dollars to do a transaction like that, but certainly talking to a lot of people, finding the right partners, finding your friends in real estate, probably the way you can do that with as little money of your own as possible and a majority of other people's.
Thank you. Again, if you are able and willing to find good deals, come to me. I can be partner with you, or I can buy it from you, give you a referral fee. But you have many people in the room as well. They will be helping you. So take your advantage and talk to them. Yes, in the back.
He wanted me to elaborate on the transaction that was crowdfunded. So what it was a mixed-use development site in Hollywood on Melrose, and it was unentitled land, C2 zoning, so it needed a zone change. The buyer came through another broker, and the buyer went through a mortgage broker. From what I understand, I never actually dealt directly with the buyer. He had his own broker, but the broker right before the transaction closed did indicate to me that the buyer actually obtained all the funds for the property through the mortgage broker who put together a crowdfunding offering and raised the funds publicly. I wasn't privy to the details on it, but I was really impressed that the buyer managed to pull that off. At that time, I wasn't really convinced that ability was out there, and it turned out that it was. So I was really impressed with that. I mean, it wasn't the fastest way to close a deal. It took probably 100 days, where a normal real estate transaction is 60, 90 days, 75. But the deal did close. I got paid, and I think there'll be a nice brand new building there in about 2 years. The buyer had a certain amount of money, and he needed the remainder of the balance of the purchase price, and that came through crowdfunding. I believe they're going to use the land as collateral for a construction loan. And will they have to raise additional capital? Probably, but at this point, I'm not involved in that development anymore. And I could certainly put a phone call in to find out, but who knows? Hard to say.
Yes.
Your question is actually a relatively common syndication strategy or tactic. Folks either own the real estate themselves already or find a good deal and have the means of closing on the deal and go ahead and purchase that. I suspect Kareem does this every once in a while. He'll see a good deal, he'll go buy it, he'll pounce on it, and then instantly refinance out. And when you refinance out, you can create an LLC or a holding company that holds the asset, and you can actually transfer interests of that LLC to other individuals who are willing to invest in them. Now, these are minority interests. And from my perspective as a real estate appraiser, minority interests in real estate are not worth their fractional equivalent. Not only can I prove that to you economically in the marketplace, but also the IRS agrees that a minority interest is not worth its fractional equivalent. In other words, if your LLC holds a piece of property that's worth $100,000 and you're selling 25% interests in that LLC, those 25% interests probably are not worth $25,000 each. They're probably worth substantially less because those 25% interests lack control and lack a market. There's no market for partial interests. It's very difficult to go out and sell those things. So essentially, you're going to take them on a discount. The buyers are going to get a discount on these things, and so really the deal must be structured from a perspective that you're going to amortize the money that you put into the deal through the sale of enough of these minority interests so that the deal essentially becomes refinanced and your money is repaid.
Brian, you just bought a building. How do you know it's a good deal? Answer this question.
Well, I think the answer to your question is really if you're planning on bringing a product on market, you got to see what your competition is, and that's going to tell you how to do it. And obviously, it's a moving target, but you have to check to see what is available similar to the product that you're going to propose. If it's a construction deal that has high risk, you got to see what other people are offering. Obviously, there's going to have to be a higher reward for a higher risk construction deal. But if you're just buying an existing product and you're going to do a slight remodel repositioning where there's little risk and probably a lower return to go with it, you have to adjust it according to what your competition is. And one thing I want to make an observation. The crowdfunding so far has been easier to fund money for people on the debt side than equity. So obviously you can use crowdfunding to finance debt as well as equity. And I think the competition that you see, you go out there and you see that the debt side is easier for the consumer to understand. They look at a loan, they say, okay, I'm investing in a loan, this is the property, this is the loan amount. They look at how much equity there is, they can more easily grasp the risk, and they can easily see the return. It's X% per year, the loan comes due in so many years. Okay, I'm going to invest in that. Versus and the equity side is going to be typically more complicated. There's more moving parts to it, especially if you're doing a ground-up construction, which has much more risk associated with it. But even a simple reposition has a lot of assumptions and time frames and budgets and projections. So really you're competing with other people to attract those dollars, and you have to pitch your deal to suit your product type. And it also depends on where you are. One of my clients, last year we did a $50 million blind pool, and most of the money was raised through private investors. We raised $2-3 million of that money through online what we're talking about crowdfunding. And we oversubscribed very quickly on the portion that we put on the crowdfunding sites because of the location of the properties that we're buying. It was all West LA. So I think that feature of our product was very attractive, very unique, because there's not that many people putting West LA product online, and we were able to sell that very quickly. So you also have to look at where your location is, because everybody understands the 3 rules in real estate: location, 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 and even the beginner or people with some experience in real estate know that. So I think that's also going to affect the pricing, how quickly you can sell out your project.
One other point I care to make too is if you look at this panel, there's a lawyer, there's an appraiser analyst, there's a broker, and there's a CPA. And what Kareem has done so well in the gregarious nature of a person that he is create these teams or just friendship alliances of panels of people like this that he can bounce these kind of questions off. The reality is you can't do what you're discussing or proposing without having a team of experts like this. Now, granted, Kareem knows more than each and every one of us. We know that. But the fact remains he has us to come to the table and discuss and consult with, and that's a tremendous competitive advantage.
One more thing I emphasize here myself. Every time I speak or I talk about or write about is, first, you have to know what you are doing. You have to become expert in the market where you are, the area, the type of property. So when you find a good deal, you know it's a good deal. And also you can contact with one of us here. You have the panel are all experts. There are a lot of experts in the room. They can help you if you're not sure. But I cannot emphasize enough, make sure you know the area and the type of property you are in, whether apartment, shopping center, industrial construction. You should know it first, study it well, and so you can find a deal, you know it's a good deal, and act fast. Because if you take a deal and try to analyze it for too long, you lose it before you know. Brent sold me a building almost 2 years ago, and there were a lot of competition, and it was a tough deal, but thank you, Brent, again, we went through it. I had to stick with him, he stuck with me. But again, if I don't know the area, if I don't know the type of building, if I don't know the management, even the bank will not have given it to me. So it's important to know what you are doing. Yes?
I don't do the debt crowdfunding site, but what I do for my clients is on the equity side, but I think if you look at the statistics that the crowdfunding sites put out, you have to kind of scratch below the surface a little bit because they talk to you about the deals that they do. And they don't necessarily differentiate between the debt that they do and the equity. But once you start talking to them after they're off the panel, you'll see that more debt deals are being done than equity deals. And I think my explanation is because it's just simpler to understand the debt side than the equity. So the question is, you find a deal, you have 10% of the money, how do you get more of the deal than the 10%, right? So that's the classic syndication structure. There's a menu of different compensations that are paid to the sponsor. First one typically is there's an acquisition fee that's paid to the sponsor. That ranges anywhere from 2.5%, 3%, whatever is consistent with like a half a commission. So there is a possibility, and a lot of sponsors will charge that acquisition fee and roll it into the deal if you want to. That gives you a chance to increase your percentage. The other fees are, for example, you charge a management fee on an ongoing basis as the deal's going on, and that's typically market, 5%. Construction and development fee, 5% to 10, 15% if it involves construction and development. Leasing commissions, again, those are typically market consistent leasing commissions. Refinance fee, anywhere from 0.5 point to 1 point. And some will charge, an advisory fee. We're doing a second fund. This one's going to be about 75 million to 100 million. This one, we're going to have an advisory fee of about 1.25% of the capital that's deployed. The big ticket item for the sponsor is the percentage of the profits. And the profits is, you have to be clear about, are you talking about profits at the back end when you sell the project, or both the profits on the back end and ongoing cash flow that's thrown off the project? Your percentage as a sponsor does not necessarily have to correspond to the percentage of the cash that you're actually putting in the deal. So you could put in 10% of the capital, but be a participant in 25% or 20%, whatever you can negotiate. And that percentage is totally market driven, and it's really determined by how sweet of a deal. If you find a great deal that your investors are in the black on day one, you can ask for a bigger percentage. And typical ratio is anywhere from 20, 25. I've seen it as high as 50%, where it's a fantastic deal.
Okay, that's enough.
Sorry.
No,
That's why my kids don't ask me questions.
No, because I appreciate that. But we have other question too. If you want to know more about it, you can ask us. Also, I have a handout about how many ways the sponsor is compensated. You can have it. You can talk to Brian. He'll be all day here. I'll be all day here. We can respond to questions. I have a couple more questions. And yes, sir.
You have to have a very well-established track record for people to trust you and give you the money with total discretion to buy whatever you think is going to make money. It's a very different scenario when you raise a blind pool versus you raise money for a particular asset, because your investor can underwrite that particular asset. But when you raise a blind pool, they're really investing the money with you. So you have to have a long track record.
Yes, from what I understand, let's just say the price was $4 million. I believe that the sponsor, the buyer, put $1 million in, and then the crowdfunding was about $3 million, and then they were going to use the property then as they don't own 100% of it, no debt. They were going to use the property as collateral for a construction loan of $10 million or whatever. And once they got the construction debt, approved plans, permits, they were going to go ahead and build the property. I drove past it.
Okay. Michael, I am your client. Somebody called Brent on the table next to you. He brought me a deal. I bring it to you. How would you know it's a good deal or not? What should I look for?
But if somebody came to me with a deal and said, I have a real estate deal, I'd like you to take a look at it and tell me what you think about it on the surface, I think it's actually fairly simple when you begin. You just look at your rentals and you look at your expenses and see what sort of a cash flow it's getting, and you go from there. So basically, for a non-professional investor, I think that at this particular point in time, you could sort of look at a real estate syndicated deal as something somewhat analogous to almost like a tax-free return on your investment. Because if you were to get 7 or 8% in a real estate deal, the depreciation that you would get against that would essentially make that return tax-free. So if you had confidence and faith in the investment and the people you were dealing with, certainly 7 or 8% return is better than you would get 3% on a bond. So I think that's a broad overview of what a real estate investment might be. I think that after that, it gets a little more complicated when you look at the real estate deal. I mean, you need to know, there's a lot of people in this audience that understand real estate, and they would need to answer these questions. But for those of you who don't, you'd have to look at more than just that. If it was an apartment building, you'd have to look at whether there were things like deferred maintenance. You know, maybe they have to put $300,000 or $400,000 into a building to get it up to speed. You have to look at the loans that have been placed on the property. I mean, they could be market value loans, or they could be loans that have indicators in them where there's prepayment penalties and increases and all those sorts of things. You have to look at the terms of the loan to see when the loans become due. So I think that in that respect, I think you'd be looking at for an unsophisticated investment, you look at a return on investment, you look at the people that you were investing with, and you look at basically your bottom line. And it gets a little more, real estate is a fascinating business for the professional people here, because you could look at an apartment building that could become an office building or a condominium or something like that. So it gets even a little more interesting than that. But I think for the classic syndicated, non-sophisticated type of investor, I think it's worth that individual's while to take that investment, bring it to a professional to get some sort of a...
Thank you, Michael. Eric, you appraise property all over.
Right.
Where are you seeing opportunity to this market?
You know, I was talking to Brent about this earlier this morning. I just finished working on some properties in the South Bay. It's an interesting story. 99-year-old man owns about 60 apartment buildings in Los Angeles County, unincorporated cities such as Gardena and
Is he selling them?
Torrance. Not selling them, but they're doing all sorts of planning. And anyway, when I was looking at the rents, I mean, generally speaking, so these are probably, you know, east of the 110 freeway, south of Rosecrans. And so LA County, Gardena, Torrance, Hawthorne. And I'm looking at these nice buildings, you know, look what I'd consider to be a B-plus apartment building, maybe a C-ish area. And the one-bedroom rents are $750 a month. Studio rents are $550, $650 a month. Two-bedroom unit rents are $900 a month. And I'm just frothing at the mouth, thinking I've got my partner in real estate here who can help me, you know, buy a few of these things. It seems to me that, and what Brent will tell us is that, in spite of the fact that these are 4-cap deals, or maybe less because of the low rents, it seems to me that the appropriate person could come in here who knows how to manage these properties correctly and maybe maintain the tremendous appearance, the good appearance of these properties in this market, and instantly turn a 3 or 4 cap into a 5 or a 6 cap relatively quickly by raising rents. Now, the question remains, how do you collect them? I know that in the past, Kareem takes guns and bulletproof vests to collect his rents.
Collect the rents.
No, see, I came from Lebanon. If I want to carry a gun to collect rent, I would have stayed in Beirut. It's cheaper, more rewarded. So I don't go to those tough neighborhoods. But to create value into this market, we have heard Steve earlier how he does it in office building. Let me tell you how we are doing it ourselves in today's market.
You've got to look at value add is the bottom line. You've got to look at value add. Value add doesn't necessarily mean the building is broken down and beat up. It could mean it's a terrific building in a not so terrific area.
I mentioned earlier that Brent Solnaz helped me buy a building in Ontario. And the property manager happened to be here today. Jared, raise your hand, please. What we are doing with this property, we are having 2 types of improvement. One improvement really turned it to much more expensive. Tile on the floor or plank vinyl, countertops, new cabinet or new appliance, make it really look like new. And we add about $100, $150 more to that. Other, we just clean it up and paint it and so on, and we charge it maybe $50 more than we were charging before. This is the type of property in today's market, especially C plus or A building or B building. I don't like A building today, and I'll tell you why. Because A building are very expensive. A lot of people cannot afford. B or good C people like to live in the neighborhood. This is what I call them workforce. They like to live in the neighborhood, but they cannot afford or don't want to pay the money for a very luxury building. But they have all the amenities they need. So this is where the value is today in many markets around. Now, there are a lot of money to be made in C and D area. I don't go there myself, but still there are a lot of money because people need a place to live and a clean place to live. So there are a lot of opportunity. You want to add something, Brent?
You're going to hear the phrase value added thrown out at every conference and magazine you read about real estate. And that really is, in this type of a market, the only way you can make deals work, because everything's a 4 cap at best. The people that I see that do really well buying in today's market are looking at a few factors. One of them would be really the profile of the owner. Is it something like what Eric just mentioned with a 99-year-old individual who probably has owned something for 30 or 40 years, the loan's paid off, and they don't need to be particularly aggressive with raising rents? We love that profile because there's probably some meat on the bone with the rents. There's a lot of people that just refuse to spend money when they have vacancies. A unit becomes vacant, they just paint, carpet, and re-rent it out, and they're leaving oftentimes $200 on a table because they don't want to spend another $5,000 on unit rehab. Those deals are out there, and you sometimes don't find out until you walk the unit and realize that the owner did nothing when the units became vacant. So you have to dig pretty deep. You got to look at every deal and really try to figure out where the rents are in line with the market. An issue that you have with Los Angeles and a lot of other areas in LA, such as West Hollywood and Santa Monica, is really stiff regulations from rent control. I tell people to be very weary about those areas because you can't really control the business plan. You can't really underwrite to how many people are going to move out. It's a difficult thing. But as Eric just mentioned, there's a lot of areas in Los Angeles County that have no rent control. Inland Empire as well. And you can go in there and you can really make a difference. You can go in there and gut the building and turn it from a C to an A if you want, if you feel it's justifiable. Again, there are opportunities. You just have to dig really deep and look at every deal with very, very, very fine analysis.
Thank you, Brian. Now we'll have 1 minute for each speaker to tell us his advice for the people. 1 minute each, please. Start with O'Brien. Any advice you like?
Make sure you pick a good team that they have the expertise and they help you add value to the transaction. Make sure you hire the right people.
Driving sucks. Follow the transportation corridors that are going up right now. It's gonna change neighborhoods, and I think we're gonna find that professionals do not want to commute anymore. We're just giving up too much, sitting in our cars, and it's costing us too much. Even with low prices of gas, it's just not worth it. And follow the Rams. I'm curious to see where the Rams go. Not only are they going to go into Inglewood, which we know about, that could have some pluses and minuses in terms of what happens over in that area. I mean, there's a history of teams being in Inglewood and great hopes and dreams that maybe never materialized. But certainly watching the Rams, seeing what happens in Inglewood, seeing where they go with their practice facilities, seeing where they go with their offices. It'll be really interesting to see what happens where the Rams go and where they start buying up property because they're going to need infrastructure and support and people to come by and cheer.
Okay, Brent.
I think to summarize, if you want to be a buyer of apartment buildings in Los Angeles right now, or even Southern California in general, you have to be very realistic. There's no steals. You're not going to find a 6 cap. You're not going to find probably even a real 5 cap. You're going to have to buy at a 4 cap and turn it into a 6 cap or a 5 cap. The financing's there. There's plenty of people that are willing to partner up with you. You just have to figure out a way to transition that property from where it is now into an asset that's going to actually give you a yield. So that's the hard work. But the deals are out there. We see tons of people buying deals and making a fortune off them. They just have to be creative.
I think that what I've seen is that you want to find something that other people don't see. There's an adage in real estate that the profit is in the ground. And what that basically means is that if somebody sees a redevelopment issue or an undervalued property or something of that nature, it's so competitive that if you see something that other people, a zoning issue or a utility issue or something like that, if you have an opportunity to invest in something like that, that's where you can make the greatest return in real estate.
Look for opportunities where building has been owned for a while by mom and pop, and they have not been maintained properly, and do something to create value. Needs cosmetic improvement, and most important, effective management. And most important, as Brian said, a good team. This is your key to success. Wherever I go, in any state I am in, before I invest, I build a team. My team depends from 5 people to 11 people. How big it is depends on how much I want to expand in the market. So this is what I advise you. Again, we'll be around for all day long, and any question, feel free to contact us, and please give a big hand to the panel.